In 2025, something extraordinary happened in the global financial system. Something that defied every traditional economic model. Gold, that ancient, barbarous relic that critics had declared obsolete, surged an historic 65 to 71% in a single year. Not 6%. Not 16%. 71%. But this wasn't just another bull market. This was a repricing of reality itself. And as we enter 2026, the question isn't whether gold will continue rising, it's whether you understand why the entire monetary system is fundamentally changing. So let's talk about the greatest wealth transfer of the 21st century in 3 parts. Part 1, the April 2025 Revolution. To understand where we're going, you need to understand what happened on one pivotal day in April 2025, a moment some analysts now call Liberation Day. For years, the gold-to-silver ratio had been grotesquely distorted, blowing out to an extreme of 105 to 1. But in April 2025, something broke. Silver exploded 150% in a matter of weeks, collapsing that ratio violently back to 62. This wasn't a price adjustment, this was a signal. The paper short positions that had artificially suppressed precious metals for decades were being overwhelmed by something far more powerful, physical demand. Part 2, the perfect storm, 3 massive forces. 3 massive forces converged in 2025 to create this perfect storm. First, fiscal dominance. The United States crossed a psychological threshold. National debt surpassed $41 trillion. Interest payments alone hit $1.5 trillion annually, more than the entire defense budget. The Federal Reserve entered what economists called fiscal dominance. The bond market did the math and realized the only way to manage this debt is through financial repression, keeping interest rates below inflation. That's mathematically bullish for gold. Second, the 3-front geopolitical risk. Throughout 2025, the world didn't just become more dangerous, it became strategically fragmented. Eastern Europe, the Ukraine-Russia war ground on, consuming billions in Western aid with no end in sight. The Middle East, Israel and Iran moved from proxy conflicts to direct confrontations. Houthi attacks in the Red Sea disrupted global supply chains. South America, in December 2025, the US designated Venezuela's government a foreign terrorist organization and launched covert drone strikes under Operation Southern Spear. A new war front opened. This geopolitical fragmentation incentivized central banks outside the G7 alliance to repatriate gold reserves and accelerate purchases to insulate themselves from potential sanctions. Third, the decoupling from reality. Here's the truly bizarre part. Gold rallied even when it shouldn't have according to traditional models. Historically, gold moves inversely to real interest rates. When rates go up, gold goes down. That's the rule. In 2025, that rule shattered. Gold surged while the Fed kept rates elevated. Investors weren't buying gold as an inflation hedge anymore, they were buying it as insurance against systemic collapse. As of January 2, 2026, gold is trading around $43.60 to $43.80 per ounce, having receded from the December peak of $45.50. This pullback is viewed by technical analysts as a healthy correction within a primary uptrend, allowing overbought momentum indicators to reset. Key technical levels, support at the $4,000 level serves as a massive psychological and technical floor. Resistance remains at the all-time high of $45.56. Institutional sentiment has shifted from skepticism to aggressive accumulation. A Goldman Sachs survey of over 900 institutional clients revealed that nearly 70% expect gold prices to be higher by the end of 2026. This marks a distinct change from previous years where gold was viewed as a barbarous relic or a fringe asset. It is now being integrated into the 60/40 portfolio as a necessary diversifier. A critical anomaly in the current market is the dislocation between the paper price determined in Western futures markets and the physical market dynamics in the East. In India, domestic prices were trading at a discount of nearly $30 per ounce relative to international spot prices. This indicates that traditional price-sensitive buyers in Asia were priced out by the rally. Part 3. The outlook for 2026 and beyond. The monetary backdrop for 2026 was set by the Federal Reserve's actions in December 2025. The central bank cut interest rates by 25 basis points to a range of 3.5 to 3.75%, the third consecutive cut of the cycle. However, the minutes from the December FOMC meeting revealed deep divisions. A hawkish minority argued for a pause, citing concerns that inflation could become entrenched at the 2.7% level. This lack of consensus creates policy uncertainty. If inflation resurges due to tariffs or energy shocks, the Fed may be forced to halt cuts, creating head fakes in the bond market that could induce volatility in gold. The single most robust pillar of the gold market is the secular shift in central bank reserve management. This is not merely a diversification exercise, it is a defensive fortification of national balance sheets. For 3 consecutive years, global central banks have purchased over 1,000 tons of gold annually, effectively doubling their historical absorption rate. This volume of buying removes a significant portion of annual mine supply from the circulating market, tightening the supply-demand balance. China remains the whale in the gold market. Although official reports occasionally show a pause in buying, the long-term strategic intent is clear. With gold constituting a relatively small percentage of China's massive foreign exchange reserves compared to Western nations, the runway for continued accumulation is vast. Import data via Hong Kong and the UK suggests that actual accumulation may be significantly higher than reported, with gold moving into shadow reserves or sovereign wealth funds. This trend is broad-based. In late 2025, Poland re-entered the market, purchasing 16 tons. Brazil also ended a multi-year hiatus, adding 16 tons. This synchronized buying by emerging markets reflects a collective loss of confidence in the G7 financial architecture. They're preparing for a world where the dollar isn't king. A critical new development is the escalation of hostilities between the United States and Venezuela. In December 2025, reports confirmed that the U.S. military executed covert drone strikes against facilities in Venezuela. This threatens to disrupt energy markets in the Western Hemisphere. Any spike in oil prices would feed directly into U.S. CPI, complicating the Fed's inflation fight and potentially triggering a stagflationary breakout for gold. President Zelensky's statement that a peace deal was 90% ready sparked brief optimism. However, deeper analysis suggests this may be a strategic mirage. The remaining 10% of the deal likely involves existential concessions regarding territory and security guarantees that neither side can politically afford to grant. A collapse in these talks in early 2026 could lead to a ferocious Russian offensive, renewing the war risk premium in precious metals. The Middle East remains volatile. Israel's surprise war preparations and ongoing anti-regime protests in Iran create a binary risk environment. If the Iranian regime feels threatened internally, it may lash out externally against Israel or Gulf energy infrastructure to rally nationalist sentiment. Both scenarios are bullish for gold as regional capital seeks flight to safety. Whether external attack or internal collapse, the result is the same: safe haven demand. Perhaps the most significant structural development for the long-term gold price is the BRICS bloc's move toward a gold-backed settlement mechanism. In October 2025, the BRICS alliance launched a pilot for the unit, a trade settlement token anchored 40% in physical gold and 60% in a basket of member currencies. Unlike the euro or the IMF special drawing rights, the unit's gold component requires participating central banks to hold physical gold. It cannot be printed out of thin air. While currently a pilot, if the unit is adopted for settling energy trade among BRICS Plus nations in 2026 to 2027, it would create a massive, sustained bid for gold. It effectively remoneizes gold in international trade settlement, bypassing the SWIFT system entirely. The de-dollarization tracker indicates that 55 countries are now using non-dollar currencies for trade. While the USD remains dominant, its share is eroding. While demand surges, the supply side of the gold equation is facing secular stagnation, often referred to as peak gold. Global gold mine production has plateaued. Major producers like Newmont and Barrick are struggling to replace reserves. In Q1 2025, Newmont's production fell to 1.54 million ounces, down from 1.68 million in Q1 2024. Barrick saw a nearly 20% drop. The geological reality is that the easy gold has been found. Miners are forced to process lower-grade ore, which requires more energy and capital, raising the all-in sustaining costs. This rising cost floor means gold prices must rise to incentivize new production. It's a structural support level that keeps climbing higher. Despite record prices in 2025, recycling volumes in markets like India did not surge as expected. This suggests holders are anticipating even higher prices. Silver warrants specific attention as it acts as a high beta version of gold with a critical industrial twist. The silver market is in its fifth consecutive year of deficit. Demand from the solar photovoltaic sector and the burgeoning AI electronics sector is outstripping mine supply. Registered silver inventories on the COMEX exchange have plummeted by roughly 70% since 2020. In London and Shanghai, vaults are also near record lows. A major catalyst for the late 2025 volatility was China's implementation of a stringent export licensing system for silver, effectively squeezing global supply. As the AI revolution accelerates, the demand for high-conductivity materials for data centers, chips, and 5G infrastructure is soaring. Gold and silver are indispensable in these applications. A key variable for the 2026 to 2030 outlook is the economic impact of artificial intelligence. There is a fierce debate among economists regarding whether AI will be deflationary or inflationary. Goldman Sachs argues that AI will drive a productivity boom, raising global GDP by 7% and boosting productivity growth by 1.5 percentage points annually. Higher productivity lowers unit labor costs and suppresses inflation. If the US economy grows at 3% plus real rates due to AI, real interest rates could rise, creating a headwind for gold. Conversely, the build-out of the AI infrastructure is inherently inflationary. AI data centers are voracious consumers of electricity. The IMF estimates global electricity needs for AI could triple by 2030. The physical hardware for AI requires copper, silver, and gold. The competition for these finite resources will drive up input costs for the entire economy. For the 2026 to 2030 period, it is likely that the resource cost of AI will dominate the productivity benefits. We may see greenflation and techflation coexist, creating a high nominal growth, high inflation environment, the perfect storm for gold. Based on the convergence of these factors, we present three probability-weighted scenarios for the gold market over the next 5 years. Scenario A, the fiscal crisis breakout. Probability, 40%. The trigger, the US sovereign debt interest bill becomes unmanageable, forcing the Fed to implement yield curve control. Real rates collapse deep into negative territory. Trust in the US dollar as a store of value evaporates. The BRICS unit gains traction as a viable oil settlement currency. Gold enters a parabolic phase, targeting $6,000 to $8,000 per ounce by 2030. Silver breaches its 1980 high, targeting $100 to $125. Scenario B, the soft landing grind. Probability, 40%. The trigger, AI productivity kicks in, allowing the US to grow at 2.5 to 3% without igniting hyperinflation. The Fed manages a slow, controlled devaluation of the dollar. Gold continues to perform as a hedge, grinding higher in line with global liquidity growth. Central bank buying provides a steady floor. Gold trades in a steady uptrend, reaching $4,500 to $5,500 by 2030. It performs well, but equities, particularly AI stocks, outperform. Scenario C, the deflationary bust. Probability, 20%. The trigger, a global recession caused by the lagged effects of high interest rates or a collapse in the AI equity bubble. Deflation takes hold. Cash becomes king. Gold is sold initially to raise liquidity, but recovers faster than equities as central banks respond with massive quantitative easing. Gold corrects to $3,500 to $4,000 initially, then stabilizes. While painful short-term, gold proves more resilient than most assets. For institutional investors, the traditional 60-40 portfolio is dead. The correlation between stocks and bonds has turned positive, removing the hedge benefit of treasuries. Gold must be viewed not as a commodity, but as the zero-coupon bond of the 21st century. An allocation of 5 to 10% is no longer a fringe view but a prudential necessity. For corporate treasurers, with the rise of supply chain weaponization and currency volatility, holding a portion of corporate reserves in gold offers insulation against FX shocks. For individual investors, the buy the dip strategy remains valid. The disconnect between paper and physical markets suggests that accumulating physical metal or fully allocated ETFs is preferable to speculative futures positions. Silver offers a higher risk-reward profile due to the industrial squeeze. It's more volatile, but the deficit dynamics create amplified upside potential. The events of 2025 confirm that we have entered a new era. Gold is being remonetized. It is moving from the periphery of the financial system back to the center, serving as the ultimate neutral reserve asset in a world where trust in sovereign liabilities is eroding. The path to 2030 will not be a straight line. Volatility will be high as the market vacillates between fears of deflation and inflation. However, the vector is clear. The structural supply constraints of peak gold, combined with the insatiable demand from the global south to escape the dollar's orbit, creates a floor beneath the market that is significantly higher than in previous cycles. In the words of J.P. Morgan Research, risk continues to skew toward reaching this multi-year target much quicker than expected. The golden age is not coming. It has arrived. If you found this analysis valuable, the best way you can support this work is to share it, engage with it, and keep learning. The financial system is changing faster than most people realize, and understanding that change is the greatest investment you can make. Most investors will buy at tops and sell at bottoms because emotion overwhelms logic. But you now have the knowledge to position differently. The structural supply constraints create a floor under the market that keeps ratcheting higher. Each correction finds support at progressively elevated levels. Combined with insatiable global south demand to escape dollar dominance, this creates a tailwind that strengthens with each passing year. This is not speculation, this is observable repositioning of global capital that's happening right now. The wealthy and institutions are already positioned. The question is, are you? This information is freely available, but most will ignore it until it's obvious. By then, the easy gains are made. From our entire team, thank you for watching. Stay curious. Stay informed. And may you navigate the golden age wisely. If you want to continue this journey, subscribe below. Thank you.